Hi, it's Arjun. This week we provide our third installment of what's been our August summer series of 30 years of perpetual transition, with a look at a number of noteworthy geopolitical world events and policy measures that have occurred. And a key conclusion is that some of these events were highly anticipated to be impactful and were not, and vice versa. Others got far less fanfare, but turned out to be more material. You've had some countries that had grand openings where the expectation was for rapid supply growth and foreign company investment that sort of petered out. And again, vice versa, some countries with not so grand openings that actually ended up faring okay. Now, 2 weeks ago, we discussed some of our favorite macro drivers that have changed over the course of our career. And last week, we focused on sectors, business strategies, and business models, and some of those have shifted. And it is all to point out that energy markets are forever. They're perpetually changing. We again recognize the term energy transition has become a loaded term that seems to mean we're going to transition away from fossil fuels only to renewables over some arbitrarily short time frame, like by 2050. That is not what we're referring to. We do not agree that is either on track to happen or that it would be beneficial for human prosperity. But it is critical that investors, executives, policymakers recognize that energy is always changing. That is the purpose of this series. And we're going to, again, talk about geopolitics, world events, and some major policy developments over the course of the last 30 years and how they ended up unfolding. So let me start with some major world events that have occurred over the course of my 30 years. The first one is, my career started in 92. The Soviet Union collapsed a few years before, but I remember this being one of the major things that got talked about oil markets in particular, and it was the collapsing former Soviet Union. And I think there were a couple things that I recall from this very early part of my career. First was the end of the Cold War was a seminal event, not just for Americans and people in the Soviet Union, really around the world. The Cold War was such a defining way in which the world thought about itself. There was a lot of talk about a peace dividend. Again, we're only a few years after the 1986 crash in oil that marked the end of the kind of 1970s and early 1980s oil supercycle. And so this was generally thought of as sort of a bearish event for oil markets. We'd have a peace dividend, therefore less expectations. The expectation was that some of these countries might open up to new supply. We were also at a time when Soviet Union demand, the demand within the countries, was dramatically decreasing as their economy collapsed. And I still remember Tom Petrie early on. I was working on a presentation for him, and there was a lot of bearish sentiment about oil demand. And remember, in the early 80s, after oil went from 3 to 30, went up tenfold, oil demand had fallen for a number of years, substituting out of power gen away from oil, that there was still a kind of a hangover, a malaise on the outlook for oil demand. And the Soviet Union was very negative. It was dragging down kind of world oil demand statistics. I remember Tom asked me for a very simple request. Let's look at oil demand X, what's going on in the Soviet Union. And that trend was generally much stronger. And the idea was people were underappreciating the underlying health of oil demand. At some point, we didn't know when, but presumably Russia and the successor countries would stabilize, and it would be more evident that global oil demand was resuming, and that's in fact what happened. I'm going to actually pull up the next three because they're good bookends. Between 1997 and the Asian financial crisis, which I talked about a couple of weeks ago, and then China joining the WTO, it was a real point of transition for oil markets. That Asian financial crisis peak for those Asian tiger countries created a lot of sentiment that the best days for oil demand were behind us. It was also a time when some of the negative or demographic challenges in Europe and Japan were becoming more evident. And the thought was, here are some major drivers of oil demand. They're starting to turn south, again, calling into question the sustainability and health of oil demand. And when China joined the WTO in 2002, I think people thought, yes, that's a pretty major thing. But no one, not even we, realized how important this was going to be as a catalyst to driving, the BRICS expansion and all that we know that happened in the subsequent super cycle. It was really a 4 or 5 year period of bookending that Asian financial crisis and China joining the WTO. But 3 events happened in between. I think the market got each of these wrong on the initial expectations. When 9/11 happened, I always say this was the worst day of my career, having to live through that firsthand, working downtown at Goldman Sachs at the time. But as far as oil markets go, the thought was, hey, geopolitical turmoil, this is going to be bullish for oil. That was not correct. Instead, we had a recession shortly thereafter, and oil prices went down. When Gulf War II started, and if you remember, the initial phase of that war was pretty quick, highlighted by the very unfortunate W. Bush headline that had mission accomplished in the background when he was visiting the troops in Iraq. A very unfortunate headline, as we know, the war or the unrest dragged on for many, many years after that. But the thought was, after Gulf War II sort of initially looked like it was over, there was going to be rapid growth in Iraqi oil supply. So it was viewed as it was going to be a bearish event for oil markets. I'm going to talk about Iraq in just a slide or two, but that idea that Iraq was opening and we were going to have massive supply growth turned out to be very wrong. And then lastly, around this time, Hugo Chavez took over in Venezuela, and Venezuela went from a rapid growth engine of world oil supply to ultimately leveling off. They ended up nationalizing most of the concessions that foreign companies had there. And of course, we all know Venezuela's economy and their oil production has since collapsed. And I'm going to say the market either ignored or got all these things completely wrong. 9/11 was bearish, not bullish. Gulf War II was not bearish. As far as Iraqi supplies goes, it was either irrelevant or probably actually hurt it. And then we all sort of underappreciated the relevance of Hugo Chavez. I think we were rightfully concerned that the Asia Tigers' best days were behind them, but then underanticipated China joining the WTO and what it would mean. A simple point here is, if consensus is going one way, you may want to borrow the line from George Costanza. I'm going to do the opposite. I think that's sort of how world events have generally played out. We've had some grand openings, some of which were heralded, some which were not. When the Soviet Union collapsed and Azerbaijan and Kazakhstan became their own countries, there was an excitement about what that could mean. We saw many of the Western companies, my memory is, of course, BP getting into the ACG field in Azerbaijan. I've already mentioned Chevron getting into Tengiz and Kazakhstan. And frankly, all the majors got into most of the majors got into these areas. It was heralded. And I'm going to say this is an area that sort of did work out. These were important fields, especially at the time. For Chevron, it still is today. I'd say maybe the market sort of got this right. When Mobil announced that they were getting into an initial Qatari LNG project, it was either Qatargas or Rosgas. I don't remember which one came first. If you followed Mobil back then, one of the big questions was, how will they replace Arun LNG, the big, very profitable LNG field they had in Indonesia? Had been running for 20 or 30 years. It had become very mature. It was a core source of Mobil's profits. And when people saw that Lunodo was getting into Qatar, everyone said, Qatar? What's going to be the cost structure of that LNG? It can't possibly be as good as Arun. And there was a lot of lack of confidence in what this could mean. Of course, Mobil ultimately ended up merging into Exxon. And I think ExxonMobil has hugely benefited from that decision by Lunodo to get Mobil into Qatari LNG. We all know this has been a massive source of success. So here's an example of an opening that was happening that, again, I think a lot of the analysts at the time underappreciated. On the other hand, you've had some not so grand openings, as we might call them. Iraq, Libya, and Mexico at various times over the course of my career have sort of, quote, opened for foreign investment, and all have massively disappointed. I will say, at least myself as an analyst, I feel like I got these calls more right than wrong. One of my observations is when a country is a major oil producer or perceives itself to be, maybe Mexico is an example of that, the contract terms are really tough usually, and therefore it's often unexciting for the companies you cover to want to get into these countries. They may want to get in, but as an analyst or investor, you got to question how much profit you're going to make when the contract terms are tough. And by and large, there's challenging contract terms. The general preference by many of these countries to not have foreign companies in their country, all that's led to, I'm going to say, big disappointments in what supply has meant. But again, when these countries have opened up, the forecast for many is often, hey, this is going to lead to a surge in supply. Not true. It was not true in Iraq, Libya, or Mexico, at least not yet. So let me just provide a couple examples here. Here's a not so grand opening. I want people to remember this, which is, this is the history of Iraq back to 1970. You could see it's had some volatile production driven by geopolitical events from the start of the Iran-Iraq war. Their production collapsed. Gulf War I, after Iraq invaded Kuwait, again, production collapsed. They had tough sanctions. The production recovered. And when Gulf War II happened, when after 9/11, W. Bush first had the U.S. go into Afghanistan, but then wanted to go into Iraq to, I guess, finish the job, if you will. As I mentioned, that initial phase of the war went relatively quickly. The US deposed of Saddam Hussein. And if you look at analyst notes and expectations at the time, the thought was that by 2010, 11, 12, kind of 10 years, end of the decade after that initial phase of the war ended, Iraqi supply would be somewhere between 8, 9, 10, even some estimates were as high as 12 million barrels a day of supply. There were all these different fields that Western companies were going to come into. And I generally took the under on that. But even I was not this pessimistic that by the time you got to 2010, Iraqi supply was still below what Saddam Hussein was producing at before Gulf War II. It was a colossal miss. And remember, this was the super cycle. This was one of the bearish factors. Those who remained bearish used to say, hey, there's going to be a bunch of Iraqi supply. And again, people also underappreciated the resilience and strength in Chinese and other BRICS oil demand. And yes, it's true. I'm showing this graph to the current period. Iraqi oil supply, to its credit, has finally gotten above its 1979 levels at the start of the Iran-Iraq war, but we're still never got above 5 million barrels a day. Right now, we're a little bit above 4. We are massively below the expectations, again, in that initial Gulf War II period. I think on the other hand, Qatar's been a smashing success, underappreciated at the time, and they've gone from a kind of a negligible LNG exporter to, of course, they were number one until the US passed it, the graph on the right, in 2023, but they're now going through another round of expansions. And Qatar has really been one of the really success stories in having reasonable contract terms, of partnering with foreign companies, of having their own state company be part of the developments as well. And it's been a real, sorry for the phrase, win-win situation between the country of Qatar and the companies and countries that have been aligned with these developments. And you've now seen flat production in Qatar for a number of years. And again, we're just going through another round of expansions here. So one of the success stories when it comes to country openings. So I'd like to hit on some US policy developments that have occurred over the course of my career and kind of talk about how they were originally viewed to how they turned out. The first was CARB gasoline, which I recall being in the late 1990s. And the initial sort of hue and cry from industry was, this is going to be very expensive. It's going to be inflationary. It's going to be a real challenge to push back on these regulations. And California went ahead with them. And I will say, as it turned out, I think Lee Raymond coined the term, but it may have been someone else, that California basically created a boutique fuel, a type of very environmentally conscious gasoline that was not replicable in refineries outside of California. There might have been one plant, I think the Neste plant in Finland could produce CARB gasoline, and maybe a Valero plant on the Gulf Coast could as well. But California gasoline ended up becoming a very profitable market, especially when you had your inevitable periods of disruption. So again, an environmental policy that industry, as I recall, was very against. And I will say that at least for some duration of a decade plus, California profitability was as good as any refining region was out there. It's since changed perhaps in recent periods, but I'd say CARB gasoline, it did not turn out as I think many in the analyst community and amongst the executives expected at the time. If people were around in that environment and want to push back, I will accept those comments. But I think most people got CARB gasoline and what it was going to mean wrong. California used to be a really good area for refining profitability. It was W. Bush that first announced various ethanol mandates. Again, this was as oil prices were rallying in the 2000s during his administration, and it was originally for geopolitical security reasons. We've since had these policies morph towards being about climate via things like renewable diesel and so forth, the low carbon fuel standard, blender's tax credit, RIN pricing, all this kind of stuff. This is one of those things that I think have been more bark than bite, if I can use that phrase again. Ethanol and biofuels on a global basis have gone from a negligible portion of liquid supply in 2000 to just 3% 20 years later. It's entirely a regulated market. We've not seen these things scale up X subsidy or tax credit. Again, I think ethanol was, while a geopolitical security, probably also a de facto ag policy to support farmers, and maybe renewable diesel has elements of that. With renewable diesel, while perhaps it is having a little bit of a negative impact right now on California petroleum diesel demand, this is a market where the feedstock cost is greater than the selling price. That's a really tough starting point. So you need the LCFS tax credit, you need RINs pricing, you need the blender's tax credit to have a positive gross margin. I'd simply observe that as long as that is the case, when your unsubsidized gross margin is negative, that's not a market that is going to scale. Yes, it can cause some volatility to near-term petroleum pricing and so forth, but I'm going to call these sort of unfortunate policies. It's not even clear to me what the environmental benefits of either ethanol or renewable diesel are. If there's an environmentalists out there watching this who believes this does provide environmental benefit, I'll take the feedback, but I'm not really sure this really helps either climate or the environment, but it certainly is not something that I think is on track to scale anyway. One of the most meaningful developments, and I think we knew was positive at the time, but we didn't realize how positive it was going to be, was the lifting of what was a ban on U.S. crude oil exports that the U.S. government had in place, probably dating back to the 70s, maybe before that. And to the credit of President Obama and his administration and all those that worked in it, and to the credit of Congress, it was split between Republicans and Democrats at the time. We actually had sensible, bipartisan energy legislation. Let me repeat that. We actually had sensible, bipartisan energy legislation. I know some of the folks involved from the Obama administration, industry executives and others. I'm actually not going to name them in this video. They knew who they are. Thank you for helping get this through. But this turned out to be certainly a great thing for American energy prices. And so I want to be clear on the result here. This was not some great victory necessarily for the U.S. oil industry, because remember, after export bans were lifted, shale production surged, and thank goodness we can export it. But we followed this period with 5 of the worst years for profitability for the E&P sector in the history of this business. So this was a boon for consumers. And it's a really important point. American consumers paid lower energy prices as a result of this policy being lifted, and so did world consumers. The U.S. has been 90% of net global oil supply over the last decade. That is entirely thanks to U.S. shale oil. And without this crude oil export ban being lifted, oil prices, in all likelihood, all else equal, almost certainly would have been much higher. So again, I think this turned out to be negative for the oil industry in the short term. Recently, profits have been much better as they've gotten some capital discipline. But I think people have to understand what the benefits of this were to society at large and to world energy prices. It kept them lower than would otherwise be the case. This legislation at the time, I think, allowed for some extension of solar and other renewables tax credits. Again, all of the above is what we should be doing. That means both encouraging our domestic oil industry, but also getting to where we can be a superpower in new energies. We want to do both. The end of the Obama administration, at least in this example, was an example of a bipartisan success. Credit to all sides, Republicans and Democrats. On the flip side, I'm going to put this in the more symbolic category, a little bit like the LNG permit ban, but where the symbolism, I think, is deeply unfortunate. Politicizing our infrastructure, politicizing Canadian oil exports to the U.S. in particular, deeply unfortunate. And so just as we were sort of allowing U.S. crude oil exports to happen, here is a policy that countered that. I think if you want to be a political pragmatist and say that President Obama effectively made a good call in sort of upsetting a bunch of Canadian oil sands producers and maybe a Gulf Coast heavy oil refinery in exchange for pleasing a much broader constituency with U.S. crude exports, you can say that's a reasonable political trade to be made if you're being a pragmatist. I would say you want to be Canada's energy, I've said this many times, people know it, is core to American security. It is core to global security. And the idea that we've now politicized oil exports out of Canada, it is deeply unfortunate. Now, from a timing standpoint, again, this was sort of disallowed just before oil prices were about to roll off a cliff. So you can debate whether this actually hurt or helped the oil industry. They didn't have to spend the billions of dollars on this pipeline. On the other hand, we did see crude by rail rise. There's no way that is environmentally better. We know that there's been some very tragic accidents in crude by rail. That one terrible tragedy in a town in Canada where some explosion happened and people died, deeply unfortunate. And when you disallow these kind of pipelines, you end up often with worse environmental outcomes. I would like to see Canada reframed away from this sort of environmental conversation to being a core part of geopolitical security. for the United States and Canada, but really for all of our allies. And I'll say this is one of the negative policy things. Its actual impact on the companies, you could probably spend some more time debating since oil prices did ultimately fall. So what can we take away from these world events and US policy highlights that I've made? I think the first is that the impact of whether it's geopolitical stuff that happens or US policy that I've highlighted, it's never as clear cut as consensus initially believed. Some events that we thought were going to matter didn't matter as much. Others mattered in unexpected ways. And some, of course, were far less impactful. I mean, it is striking again that sort of 9/11, Gulf War II, Hugo Chavez, I mean, do the opposite of consensus. That is going to be one of the takeaways here, at least the initial reaction. Let's just end here, talk about some future policies and what I think people should pay attention to and maybe what they shouldn't pay attention to. Currently, we have, I'm going to call it a major misdirection going on, where there's a perception that we're debating energy transition, that we're debating some notion of moving away from fossil fuels into only renewables by an arbitrarily short date. That isn't happening. There's no evidence that it's happening. There's no evidence it's about to happen. And there's no evidence that if it actually did happen, that somehow this would be good for anybody or anything, including the climate, by the way. But yet we spend a lot of time debating energy transition, being Paris aligned and net zero by specific years. None of these things, in my opinion, is going to drive energy or, for that matter, the environment. And if you are somehow a climate activist watching this video, if you do care about the climate, if you do care about the environment, in my view, this is not the pathway to get what you want to happen. We have to solve for everyone on Earth being energy rich and economically rich. It's going to be different time frames for different countries, but that is the destiny of everyone on Earth. No one deserves to be left behind. But when you have billion people populations that do not have sufficient crude oil or natural gas, they are going to be highly motivated to figure out alternatives. They need to take those seriously. They're not ready, the alternatives for prime time today, not at scale. But it's also foolish to think that over 75 years, nothing will be developed. And that is your over-under. We will crack the code on new energy technologies. You're going to have to, if you're going to make everyone energy rich over the course of the next 50 to 75 years, and that's going to be the driver. I would encourage anyone watching this video to stop spending as much time worrying about this kind of stuff. You can worry about it if you want. I'm just going to say it's not going to be the driver of energy equities or the performance of companies. Overhyped? Biofuels, I already mentioned that. Generally a fabricated market. If you want to harvest tax credits, you can do it. I'm personally not sure that's such a great thing, but they're a small share of the oil markets. They're not on track to be a large share. The Inflation Reduction Act, as currently written, I want to be clear about those words, as currently written, where you're picking some winners, you've got some excessive subsidies on stuff that is unclear the degree of timing in which it's going to scale, I'm going to say is overhyped, both in terms of its ability to lead to displacement of fossil fuels or its ability to help the environment. Either of these things, which are supposedly the goals, I'm going to really question how much the IRA is really going to make a difference. I think EV mandates are ridiculous. Forcing EVs prematurely is the issue. EVs are going to grow. And I think they can actually take meaningful share over a long time, but they have to be allowed to grow naturally. And I will absolutely, I'm going to guarantee this, all these EV mandates, say 100% in places like California by some near-term year, are going to get delayed, or de facto, people will figure out the way around it. We're going to have hybrids grow, we're going to have EVs grow, and some people are going to still want to drive gasoline cars. If you want to mandate anything, how about maximum vehicle weights? That actually could make a difference rather than an EV mandate. And the hydrogen is probably the most kind of crazy of all the mandates or expectations to see out there. This is an existing hydrogen market, which makes sense. But here I'm going to align with climate activists because I agree with them. It takes so much energy to make hydrogen. It's going to take energy to make energy, which is sort of crazy. That if it's not for the incremental uses beyond the existing markets, if you're not using new sources of, say, solar and wind to make hydrogen, and you're matching them on an hourly basis, as I think they would prefer to be the case, what are you doing here? You're probably adding to carbon emissions if you do it any other way. And meanwhile, you need massive subsidies to get this stuff off the ground. I'm going to say that I'm generically a hydrogen skeptic. It doesn't mean no project's going to work. Again, this is going to be solidly in the tax credit harvesting bucket. I really struggle with how that makes sense from a from a societal standpoint. But if you're going to do this, it darn well better come from low carbon sources because there's otherwise no point to it. There really isn't any point. Underhyped is the importance of the Arctic. I've now mentioned this a few times. It cannot be that the US, Canada, and Norway have either shut off or are threatening to shut off their access to the Arctic for oil and gas companies, yet Russia is going to pursue its share of the Arctic. There's no way that makes sense. This is an important area of resource. We should adhere to strict environmental and labor standards, but it should not be off limits so long as Russia has it on limits. I worry about US export policy, irrespective of whether a Republican or a Democrat is in power. When all prices are in a trading band, there's nothing to worry about. But what if, like we saw in PJM capacity markets, the price increases 10 or 100-fold or some large amount, whatever the amount is. Maybe it's a double, triple, quintuple, some meaningful increase. We saw oil go from 3 to 30 in the 70s. We saw it go from 20 to 147 in the 2000s. So there's a history of, at times when you do get to a super cycle, not our call right now, you get meaningful jumps. I would worry that a future US president, given how important gasolines are to popularity ratings, could think that somehow suspending US exports is a good thing. It is, I'm going to say, I suspect it'll be a terrible thing, including for our allies and including for American energy prices. But whoever said politicians pursue good energy policies, and again, that's bipartisan, sadly. I worry most about this. I think underhyped is Venezuela. It is a country with tremendous resource. The Orinoco Belt projects were some of my favorite projects at the early part of my career. If I could pick sort of a favorite oil basin that I would like to see open, it would be the Orinoco Belt with pre-Chavez, I'm going to say Luis Justi era contract terms between those oil fields and the Gulf Coast refineries. It's a beautiful partnership when it existed. Someday we can all hope, I better knock on wood when I say this stuff, that can come back. And it's one of the areas, maybe underhyped isn't the right word, but where I'd like to be optimistic. We need to stop picking winners. We need to incentivize technology progress. We want to be a leader in technology, and we need to figure out, how is India going to meet its energy needs? How is the rest of Southeast Asia going to want to meet its energy needs? And how is we as a country, as Americans, can figure out what are the technologies that we can develop here, aside from selling them crude oil and LNG. You're going to want to figure out a way to sell them technology progress to help meet the demand with non-crude oil and LNG sources. I'd like to do that without subsidy. The final policy point that we need to get right is, how do we improve the health and resilience of the electricity grid? Now, I'm not a power markets analyst. I know that there are big changes going on here. There's an aging grid. There's more intermittent resources. There's too much retirement of base load capacity. There's not enough transmission lines in the area that need it. There's probably a whole bunch of regulatory and policy reform that needs to happen. This may be the number one thing, more so than anything else that I mentioned, that US and frankly, global policymakers need to get right going forward. So I'll end this video on a personal note. And I want to stick with this theme of 30 years of perpetual transition and talk about something that hasn't changed. From when I was a junior analyst at Petrie Parkman, through my career at JP Morgan and Goldman Sachs, through all the board and advisory work I've done, to now my time at Veriten, and that was modeling discipline, caring about models, doing my own numbers, even when I had a team helping me, and understanding how to reconcile supply, demand, returns on capital, balance sheets, and not simply relying on opinions or perceptions or the modeling of others that might not have the sensibility of checks and balances. So the picture here is just my oil demand derivation, which is a very simple top-down look at GDP growth, efficiency gain, so number of barrels it takes to generate $1 of GDP. That does improve every year, but it improves at a rate far less than is needed to ultimately cause oil demand to level off. There's no evidence, there's zero, that this is on track to change anytime soon. We can always have slower GDP growth in China or elsewhere. That is a major risk to oil demand without question. But the idea that we're having some mixture of substitution or fuel economy gains, it isn't in the data. This, on a personal note, is not about defending the obliteration of peak demand. It is to show that my confidence comes through doing models. There is no substitute from getting away from that. And what I do notice is, as people become more senior, oftentimes they too much rely on others, junior people or others, to do the models. I think, like at Goldman Sachs, I had a great team, some of whom watched this video, all of whom immensely helped me during my time there. But I think they would all tell you, I knew my numbers and I knew my models. And as an analyst, you can see that in corporate executives. You can see the CEOs, you can see the CFOs, you can see the heads of business units or the presidents of companies, whatever it is, COOs, who actually understand the project economics, who understand these kind of things and are in the weeds on the numbers, appropriately so, where they're just not relying on junior staffers or others to present them Excel models. I think it's hard to overstate, I think, the importance of modeling discipline. I'm going to cite one of my heroes, Dr. Dan Yergin, as someone very senior, a senior statesman, but who clearly has stayed on top of the numbers. You can see it in how he talks about copper markets relative to electrification. We see it in Dr. Vaclav Smil, another real hero of mine. Modeling discipline, I can't overemphasize. Not everyone's a numbers person, but if you're presenting analysis, as we see from many major institutions, a lot of the numbers don't reconcile, and I don't know why that doesn't bother people. If I could make one plea to everyone, never stop modeling. You're senior to do it. It should never be just handed down to junior people to do. You need to know your own numbers. Thank you.